institutions, where would major corporations turn to conduct their business? Because my sense is, hopefully not China, but it could be China, and then also the European banks. Same question, Mr. Diamond.
I think that you would have large banks around the world step in. There would be Japanese banks, Chinese banks, other healthier banks in Europe.
And what risk do you think that presents to the U.S. financial sector?
I think it presents risk to the United States economy over time, and there would just all things being equal, our economy would be much worse than it would otherwise have been.
Thank you. With that, I'll yield the balance of my time.
The gentlewoman from California, Ms. Porter, is recognized for 5 minutes.
Thank you, Madam Chair. Mr. Diamond, you're an expert on financial statements and you run a $2.6 trillion bank. I know you're good at numbers, and you've shared lots of opinions recently about how the U.S. should budget its resources, how families should budget their resources. I read your 50-page shareholder letter, and so I'd like to ask for your help on a problem. I went to monster.com and I found a job in my hometown of Irvine at JP Chase. It pays $16.50 an hour. And so I wondered if I could, if you'd indulge me, when you do the math on this and you do the $16.50 out at 40 hours a week for 52 weeks a year, it comes out to an income of $35,070. Now this bank teller, her name is Patricia. She has one child who's 6 years old. She claims the one dependent after tax. She has $29,100. We divide that by 12, and she's got a monthly budget.
Parliamentary inquiry.
Gentleman is recognized for parliamentary inquiry.
I just want to understand the committee practice as it relates to signs and sharing this information ahead of time.
You can't see it. I'd be pleased to share it.
No, I just want to understand because I've been on the committee for 15 years, and this is not something I've seen. So I just want to understand the practice as we go on.
The gentleman has stated his parliamentary inquiry. Yes, the sign should have been presented to you, provided copies so that all members can see. We have an alternative. If we could break and put them up for everyone to see, would that be acceptable?
Well, it's a whiteboard that I've noticed, and I haven't seen that in committee. Actually, I've seen it for a long time on TV. So I just want to understand the committee practice as it relates to that. What we have on the screens has been vetted by both sides and given ahead of time, and that's been the committee practice, but I just want to understand this.
The gentleman is correct.
May I respond? I do not intend to enter this into the committee record.
What's that? Yeah.
The gentlelady is in violation of the practice of making sure that all members can see what it is you're showing to the witnesses. So again, if it can be put up on the screen, then everybody can see it, then we can proceed. Can that be put up on the screen?
Ma'am, I'm happy to proceed.
One moment, please. What we will do is we will move past your questioning while we try and get that up on the screen for all the members.
If the chairwoman would indulge me, I would prefer to proceed without the whiteboard if it presents a violation of a rule.
Thank you, and in the future we'll work with you to make sure that the practices are understood so you won't have an inconvenience.
And
thank you for the inquiry.
Chairwoman, thank you so much.
And I would offer the same likewise so we can understand committee practice on this. I thank the chair.
Thank you very much. We'll proceed. Ms. Porter, you may continue with your 5-minute questioning.
Thank you. So where we left off was this woman had, and I apologize, you're going to need to follow orally. She had $2,425 a month. She rents a one-bedroom apartment. She and her daughter sleep together in the same room. In Irvine, California, that average one-bedroom apartment is going to be $1,600. She spends $100 on utilities. Take away the $1,700, and she has net $725. She's like me. She drives a 2008 minivan and has gas, $400 for car expenses and gas, net $325. The Department of Agriculture says a low-cost food budget, that is ramen noodles, A low food budget is $400. That leaves her $77 in the red. She has a Cricket cell phone, the cheapest cell phone she can get for $40. She's in the red $117 a month. She has after-school childcare because the bank is open during normal business hours. That's $450 a month. That takes her down to negative $567 per month. My question for you, Mr. Diamond, is how should she manage this budget shortfall while she's working full-time at your bank?
I don't know that all your numbers are accurate. That number is generally a starter job.
She is a starting employee. She has a 6-year-old child.
Okay,
This is her first job.
And you can get those jobs at a high school, and she may have my job one day. So
She may, but Mr. Diamond, she doesn't have the ability right now to spend your $31 million.
I'm totally sympathetic.
She's short 567. What would you suggest she do?
I don't know. I'd have to think about that.
Would you recommend that she take out a JP Morgan Chase credit card and run a deficit?
I don't know. I'd have to think about it.
Would you recommend that she overdraft at your bank and be charged overdraft fees?
I don't know. I'd have to think about it.
So I know you have a lot
I'd love to call her up and have a conversation about her financial affairs and see if we can be helpful.
See if you can find a way for her to live on less than the minimum that I've described.
Just be helpful.
Well, I appreciate your desire to be helpful, but what I'd like you to do is provide a way for families to make ends meet so that little kids who are 6 years old living in a 1-bedroom apartment with their mother aren't going hungry at night because they're $567 short from feeding themselves, clothing them. We allowed no money for clothing. We allowed no money for school lunches. We allowed no money for field trips, no money for medical, no money for prescription drugs, nothing. And she's short $567 already. Mr. Diamond, you know how to spend $31 million a year in salary, and you can't figure out how to make up a $567 a month shortfall. This is a budget problem you cannot solve.
With us, she does get full medical. We pay 90% of it. And we also give people
No deductible?
There's a deductible, but for people doing their wellness programs, okay, we give the people making under $60,000 a year a $750 account.
Correct.
And effectively, they have no deductible.
That's why I didn't put any medical in, Mr. Diamond. I read that in your shareholder report. That's why I didn't include any medical expenses, but she's still short $567, as are all of your employees in Irvine, California. Any ideas? Okay, moving on. I have a question for Mr. Solomon. I know Goldman Sachs is launched this 10,000 Women initiative. And I've read about it. Do you know about how many people there are in the world?
Sorry? Yes, I do. A little less than 7 billion.
How many people are there in the world?
I said a little less than 7 billion.
Okay, so let's assume half of those are women. Let's just take your figure as right, 3.5 billion women, and Goldman Sachs' big initiative is to help 10,000 of them. Is this initiative missing a few zeros?
It's an initiative that we started over 10 years ago to try to help women in developing economies where they didn't have access to resources, try to help them provide, because in these communities they ran small businesses where they hired people locally. It's been very successful. We've now expanded it. We've put the programs up online, and we continue to invest in it. But we'll certainly consider whether or not we can broaden it. But I think it's an excellent program, and we'll use our resources to expand it.
The gentlelady's time has expired. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairwoman, and thank you to our panelists today for taking time from what I know are busy schedules and busy businesses that you have. I am a small businessman and new to the Congress, and have found myself availing myself and my business availing itself of the services that your entities provide, and appreciate the important role that you play in providing financial services to our small businesses across the country. So thank you for the good work that you do. I'd like to direct a few comments to you, Mr. Diamond. You stated in your shareholder letter this year that the country desperately needs mortgage reform. And to quote, "It would add to America's economic growth, reducing onerous and unnecessary origination and servicing requirements, and opening up the securitization markets for safe loans would dramatically improve the cost and availability of mortgages to consumers, particularly the young, the self-employed, and those with prior defaults. And these would not be subprime mortgages, but mortgages that we should be making. By taking this step, our economists believe that home ownership and economic growth would increase by as much as 0.2% a year. I understand that I don't want you to get too far into the weeds, but can you tell me more about your views at a high level on what housing finance reform should look like?
We required housing finance reform because we had a huge housing finance problem, and it was both government policy and bad underwriting by a series of banks. But the reform went so far that I've mentioned there were 3,000 servicing and origination requirements, sometimes different by state, so it's very expensive. Securitization was supposed to have been done by now, so they would reduce the cost of the mortgage. Those two things alone would reduce cost of mortgages to consumers by 20 or 30 basis points. In addition to that, the lack of legal safe harbors is that a lot of banks stay away from doing things for self-employed prior defaults because of the legal risk. The reform of those things would dramatically improve the markets for everybody. And I think it would make it a healthier financial system, not a weaker financial system. And in that letter, I do point out, if we did infrastructure right, 0.2% growth, immigration reform, 0.2% growth, and you go on and on and on. And so I'm making the point that a lot of the policies that held us back were our own policies. And if we fixed them, we'd be in far better shape, and growth would drive wages, jobs, and everything that everyone in this room wants for Americans.
Would you agree that the GSE conservatorships are unsustainable and that they need to end during this administration?
Generally, yes.
And that would you agree that any government guarantee should be, number one, limited to the security, not the entire balance sheet, paid for, and come behind significant private capital in the first lost possession, kicking in only in the most catastrophic of economic crises?
I think that would work. You know, I mean, look at mortgages. You got to get all the pieces right. So you can have that. It has implications in other parts, but leaving the government guarantee to a certain amount, very riskless relatively, that the mortgage originator should pay for the losses first, so the government and the taxpayer never has to pay for it. I think you can have a very healthy 30-year mortgage and let the private sector do the other 50%.
Do you agree that that reform should significantly, and I think you just answered this, but should significantly increase the role of private capital in bearing the risk?
It would increase it, yes.
And so do you believe that these reforms should forever end the too-big-to-fail mortgage companies?
I think that would probably end it, yes.
Additionally, you mentioned the innumerable regulations regarding mortgages, and you just reiterated that. Can you elaborate on why it's important to address housing finance reform now while the economy is strong?
Well, the example is you want to fix your roof when you can and not wait and create additional problems down the road. And this reform would do all of that.
And I think it's been referenced earlier, but much FHA lending has moved to the non-bank sector, which does not have the same high capital standards as the institutions arrayed here today. Is there a risk to the taxpayer here?
Yeah, almost all that's being done by the non-bank sector, and almost all of it's being guaranteed by the federal government. And when we look at it, yeah, there's increasing risk in FHA guaranteed loans.
Thank you. I'll yield back the balance of my time.
The gentleman from Utah, Mr. McAdams, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you all for being here today. In your various testimonies, most of you spoke favorably of the changes in the financial system since the financial crisis and post-enactment of Dodd-Frank. And for me, that's good to hear. I do believe that the financial system has made a number of important changes since 2008. Your institutions hold more capital. Dodd-Frank required important stress testing and resolution planning processes for our largest financial institutions. And importantly, Dodd-Frank created the Consumer Financial Protection Bureau, which was designed to be the cop on the beat, looking out for the consumers. Many of your institutions have also raised concerns about various regulations implemented post-financial crisis. And I understand that. Lawmakers and regulators will never get everything perfect the first time around. And I certainly support making our legislative and regulatory framework, making sure that our legislative and regulatory framework are working as designed while ensuring that we also protect the financial system and protect our consumers. So my question to the panel is, and everyone should feel free to respond, maybe start with Mr. Corbat and Mr. Diamond, but my question for you is, where is our current legislative and regulatory framework lacking? And what improvements could we make to ensure against additional risks to the system?
Sure, thank you for the question. I would say the main area of focus, my suggestion would be on harmonization of regulation. We all deal with multiple regulators, and on occasion our regulators are not in agreement in terms of actually what a regulation says and how it should be implemented. And that's not just domestically, but internationally as well.
I think Dodd-Frank created capital, liquidity, and resolution things which are very good. After that, there were tens of thousands of rules and regulations that came out from regulators around the world, some of which are just bureaucracy and checking the T and dot and I, which cost money and get passed on to customers. So I would just say, and we don't want to change everything, just calibration, harmonization, and we should drop the mindset it's either more or less. Some of these things, if you fix, would be better for Americans. And I'm talking about the Americans you're trying to help, not the people sitting at this table today.
I agree. I mean, the multiple regulatory agencies in this country reflects the complexity of the country, the size of the economy, but it also does create enormous inefficiencies. The international lack of harmonization means that you have arbitrage with companies operating outside the United States, which is not in the United States' interests. And thirdly, the level of just bureaucratic complexity around the regulations. I mean, we should be focused on finding the real problems and obsessing as management about the real problems. Our CCAR plan this year was over 71,000 pages. There's a general belief that the regulatory environment has changed dramatically in the other direction. Last year was 56,000 pages. So it's just, there's some simple changes that I think would make the system work much more efficiently and find the real problems.
I think if you go back and think about some of the principles that were trying to be embedded in Dodd-Frank, and
Please speak up, Mr. Monahan.
you go back and think about some of the principles that were embedded in Dodd-Frank, or at least the lead up to it. One of them was if it's an activity, it should be regulated by all, and we've lost a bit of that. A second was, as my colleagues have said, to try to get the calibration fairly balanced between growth and safety and soundness, and that's a second question. And the third broad regime, less about Dodd-Frank, more about was to have harmonization around the world so there wouldn't be arbitrage between jurisdictions. That has not come close yet. And now, is that a big deal for America? No, because we're the tightest. So therefore, the FDIC insurance fund, which we all basically back in the end of the day and have to contribute to, it's a government guarantee, and we all have to fill it up when it's not there. It'll be fine. The institutions are strong. America will be better. But the reality is that there'll be the issues around the world haven't been dealt with yet. And if you got that more level, it'd be workable.
I'd agree with the harmonization theme, and I in particular would look at activities, particularly around payments, where you've got this very different regime being posed on banks versus non-banks. Consumers aren't being protected at the same level as they are, so I would really look at this point on activities and how activities are being regulated.
The only thing I would add is I would pick up on what one of my colleagues references was just the logistics and the amount of material it takes to actually fulfill all the obligations. Referred to the CCAR submission. Same thing is true of the living wills. And the expectation that management teams, boards, and whatnot really can review all that information is just a little...
Gentleman's time has expired. The gentleman from Wisconsin, Mr. Stile, is recognized for 5 minutes.
Thank you. I want to thank the committee for calling today's hearing. This hearing's a great opportunity, I think. For the first time in a decade, we have the CEOs of our country's largest banks testifying before this committee. You're the leaders of major financial institutions that employ hundreds of Americans and play a central role to supporting our economy. Companies in Wisconsin rely on financial services that you provide to export products made in Wisconsin to ship them around the globe. You'd think members of this committee would take the opportunity to ask the witnesses questions of substance, but instead, at times, today's committee hearing is drifting from that, and we're focusing in on climate change and other pet issues. We have serious questions that I don't think have gotten the attention that this committee deserves. One of our closest allies and a major economy and financial center is facing the possibility of a hard Brexit in a few days. China's slowing and the Eurozone banks are struggling. Our country faces sustained cyber attacks. Sometimes state-backed entities are at the back of that. Regulations continue to drive small banks to close and consolidate across the country. Financial technology continues to transform the way American consumes financial services. We're spending hours today, I feel, looking back 10 years, where we should be looking to what we can expect over the decade to come. I want to look with your guys' judgment here, and in particular, what I view as the IPO drought. We've seen the total number of public companies in the United States has been declining, in particular over the last 10 years. Companies are going public later if they choose to go public at all. And this just doesn't impact businesses and their growth strategies. I think it hurts average Americans who are relying on publicly traded companies to save for their retirement. And I'm hoping you can comment on what you view as some of the factors are that have contributed to this current situation. Things like Dodd-Frank, conflict mineral regulations inside the SEC. I'd look for your comments and thoughts as to what we can transform to address this IPO drought. Maybe Mr. Diamond, you have a thought?
So first of all, we have gone from 8,000 to 4,000, and private equity's gone from something like 1,000 to 8,000. I'm not saying they're bad. And there's some good attributes. It's good that you can raise capital in private markets. It's good you can stay private for longer. And there are things which are driving it out. The cost of the much higher risk of litigation for public company, shareholder meetings, which pretty much become a waste of time, certain corporate governance things with dyeing the T and crossing the I. If you speak to any person who was a CEO or board member of a public company, and they're now in a private company, they'll tell you we spend all our time on better products, better services, strategy, risk, forward-looking, and very little bit of the time on check-the-box presentation. So the cost of litigation in this country is much higher. And again, we have one of the best legal systems in the world. If you travel the world, our rule of law is exceptional. That doesn't mean we can't reduce the cost a little bit. And there's a whole other litany of things which are driving companies private. You know, J.P. Morgan Chase is owned by 100 million Americans. Indirectly, one way or another, through pension plans, with state pension plans, municipalities, veterans, et cetera. And we feel a huge obligation. But I would love to be private. I can't.
Thank you. Mr. Solomon, do you have a...
I think Mr. Diamond talked about the growing cost of being a public company. If you look over the last 20 years, the cost of being a public company and the friction that's associated with being a public company has only grown. At the same time, the availability of capital privately has expanded very, very significantly. So if one of the primary reasons that a company goes to the public markets is for access to capital, if that capital is available privately and you can operate your business privately, and the cost and the burdens of being a public company continue to rise, the incentives to be a public company are very, very, very low. And so that's one of the reasons why you see companies waiting longer and longer and longer and longer to go public. So if you wanted to do something that would change that over time, we have to find ways to lessen the burden of being a public company, because I think the availability of private capital is something that's here to stay. I don't think that's something that can be reversed. And I actually think that's, as Mr. Diamond pointed out, good for the system.
Thank you. Anyone else? Mr. Gorman?
I mean, there are many changes Goodman suggested here. I mean, just take the quarterly reporting of public companies. We're all about to enter our earnings season. We're all working on our earnings reports. The problem is quarters come around with alarming frequency every 13 weeks. And it doesn't make sense. Investors, the public, regulators, legislators do not learn a lot by having that kind of burden on companies. But that's just an example. It's seeking perfection in the place of what is practical.
Thank you for your time today. I yield back.
The gentlewoman from Virginia, Ms. Wexton, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to the witnesses for coming today. I know it's been a very long day. I think we're starting to see some light at the end of the tunnel here. I want to switch gears and talk for a minute about the Fed. And as you all are probably aware, Stephen Moore is under consideration for appointment to the Board of Governors of the Federal Reserve. And I want to talk about that for a little bit. So Mr. Moore has taken a series of controversial stances about the Fed, despite acknowledging that he still needs to learn more about how the regulator works. He previously said that the Fed should be scrapped in favor of the gold standard. He called on the Fed to hike rates during the Great Recession because he believed it was necessary to get less dollars out in the economy, that was a good way to deal with it. And those are his words, not mine. And he recently said that Fed Chairman Jerome Powell should be fired for rate hikes or rate increases last year that, in his opinion, diluted the gains from Trump's tax cuts. So this is just a yes or no question. If we could go down the panel, starting with Mr. Corbett. Do you think the Fed should be scrapped in favor of the gold standard?
No.
No.
Absolutely not.
No.
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 Thank you. Now, I know that all of you were working in the financial services sector during the Great Recession. Even knowing what you know today and knowing what you knew then, do you think that a better way to deal with the Great Recession when it first, at the onset, would have been to hike rates and constrict dollars in the economy? Mr. Corbett?
I do not.
No.
No, not at the time of the Great Recession. No, I think that would have been terrible.
No.
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 And final question on the Fed issue. Does it cause you concern that someone who holds these beliefs is being considered for appointment to the Federal Reserve?
I don't know the candidate.
No, I'm sorry, the question was, are you concerned that someone who has these beliefs is under consideration for appointment? Would it concern you to know?
I would have to see all of the beliefs of the candidate.
I just want to start by saying I have enormous faith in Jay Powell and a lot of the Fed governors. This is not a traditional choice. I don't personally know them. I see them on TV, and I don't personally know what they think. So I think that's why the Senate has confirmation, to dig into what they really think and how they would act under certain circumstances.
But it would give you pause if someone believed that we should return to the...
If they believe that, yes.
Okay.
I'm not sure he believes that.
I believe in the independence and integrity of the Fed. It's held us in good standing for many decades. I also believe in the role of the legislative body to properly vet candidates for it.
Mr. Moynihan?
I'd agree with Mr. Gorman.
We have the best central bank system in the world, and I think it's up to the confirmation process to vet this candidate.
I agree with Mr. Gorman.
I have faith in the confirmation process.
So based on that, I do have one more question about this issue. Is one of the things that has really made the Board of Governors and the Fed function so well is that it is, for the most part, devoid of politics, that politics don't factor into that at all. Would you agree with that statement, and would you be concerned if politics were injected into the office?
The independence of the central bank is integral to its credibility.
Absolutely. They have a tough job to do. Enough as it is. It should be clear of politics. I would not say that that's always been true.
I mean, politics does impact it one way or another just because you have fiscal policy through the executive and legislative branch, and you have monetary policy through the Federal Reserve. So there's some interaction, but generally aiming for maximum independence is obviously the gold standard.
An independent Fed is critical to the success of this country, and you can observe countries around the world without an independent central bank and what happens, and it's generally not a good outcome at some point.
The independence of the Fed is a relatively recent phenomenon, and I think the Fed has been better because of it.
I do believe that an independent Fed is best for this country.
Strongly support a very independent Fed. I agree with Mr. Diamond's comment. At times politics have an influence, but we should make it as independent as possible.
Thank you very much. Yield back.
Thank you. The gentleman from Virginia, Mr. Riggleman, is recognized for 5 minutes.
Thank you, Madam Chair, and you have another Virginian. So I apologize about that. 2 Virginians in a row is very tough for people to take, especially me. And I want to say this right now, is that I want to do a quick background. First of all, thank you for being here. I'm very happy to be on financial services because there's 3 things. I really wanted to do legislation as a brand new member of Congress. You know, create jobs and economic growth in the United States, protect the national security of the U.S. financial system, right, and help banks of all sizes lend money to American consumers and legal businesses. I was a little bit concerned today when they were asking you about the businesses that you would lend to, because I distill ethanol. then I breathed a sigh of relief because it's whiskey and people can drink it. So I'm very excited right now that you guys would still fund me as a whiskey maker, because that is the American dream, and I do appreciate it. And as I go forward in this and the questions that I asked, I have another background portion of my life I want to talk to you about, in that I built fusion centers, data fusion centers for counterterrorism and counterintelligence, and also did big data aggregation for critical infrastructure attack, and also did some cyber stuff too. And the reason I wanted to talk to you guys right now about policy is I wanted to ask some questions on policy and things that are actually concern me as you go forward, and also about you being the tip of a spear for sanctions support. And I've been listening to a lot of the questions today, and I haven't heard a lot of questions on sanctions support. So I went to the Department of Treasury and saw there's over 2,400 sanctions in place for countries and also for certain types of things. And my question to you, and I actually wanted to start with Mr. Solomon because I read everything you were talking about with cyber, and I was very intrigued by it, is that as you go forward, and when you're doing sanction support, you guys are the tip of the spear for that. And I don't know if you can answer this question specifically, but do you see that there's more attacks by you on a cyber basis once you do start sanction support? And do you also see that you get hit a little bit harder on, say, your attack vectors or your risk management frameworks or things of that nature as you guys go forward? Because I see that you guys are so involved in sanction support, and I wonder, with me working on risk management frameworks on the defense and offensive side, if you've seen actually increase, when you guys go forward on sanction support, do you see an increase on attacks into your area on the cyber side?
So I appreciate the question, and it's an interesting question. I can't personally give you a specific answer, but I know there are people at Goldman Sachs that could give you, very detailed analysis on what we see. I'd be happy to come back to you.
That's fantastic, because also I think one of the banks up here are members of the fusion centers. Actually, well, which bank is that? I'm sorry. Is it right? Is it the Pittsburgh Fusion Center?
We have, I don't know if the four are completed. We have one in downtown New York. We have one in Baltimore. We're building one in Singapore, and we're building one in Glasgow, I believe.
Right, and this is actually a curiosity question because I could not find it. And I wanted to ask you, do you share information sort of on a risk matrix? Or do you share information on best practices for cyber defense amongst the banks? And I know there's, the Fusion Center that you discussed. Do you share information amongst yourself at some level based on what you see as far as predictive analysis and based on sort of, when you talk about systemic risk, right, looking at the predictive analysis portion of what you might see?
There's certainly sharing of attacks that occur with the government bodies, and then they're distributed through the industry to prepare everybody, give maximum defense. On actual risk algorithms and so on, I'm not sure.
Yes.
To get back to you, Congressman.
Thank you so much. And Mr. Diamond, and the reason I'm asking you specific questions, again, this is out of curiosity, as you go forward on this, do you, and you can answer this the way you like, would it help if you could actually, with foreign subsidiaries, actually share information with foreign subsidiaries based on the risk management frameworks that you have?
Yes, it would. And the companies here do a tremendous amount of work together. Openly, we call each other, we see a problem because it's coming their way, it's going to come my way, and we do share it. And there are a lot of things we can do to make this work far better. And in fact, I've mentioned that we're all meeting later with Secretary Mnuchin, Department of Homeland Security, all of our chief risk officers, and all the chief risk officers from all the agencies and regulators, so we can try to make this work more efficiently and better to protect the United States of America.
The thing that's, I think when you look at sanction support and what you're doing in the cyber defense field, the thing that looking at 314B, I actually read a lot of this policy, and I read all of your, sort of the portions of the cyber defense posture that you have. That's why I was so particularly interested in what you wrote, Mr. Solomon, on cyber defense, because I saw that you guys were using machine learning and AI, because you were looking at like future bug bounces as far as looking at RMF, if I use that correctly. And I think as we go forward, and I think what I would like to do is we're doing this, is that I would hope there's alternative approaches under 314B where all of you can work together in fusion centers to make sure if we're doing sanction support, that we actually have risk management frameworks in place that you can sort of work across. And I would hope at some point, because I think right now, and I'm going to ask, if somebody wants to ask this question, I have 20 seconds, is it right now illegal, or do you got the title?
All know that you profited tremendously from the tax cuts, but I just want to run through a few of them. Morgan Stanley, $1.1 billion, Citigroup, $1.7 billion, Goldman Sachs, $1 billion, Bank of America, $3.5 billion, JP Morgan, $3.7 billion. Meanwhile, each of you makes at least 150 times what your median worker is being paid, and 3 of you on this panel make over 350 times what that median worker makes. Given that the administration's rationale for those tax cuts was so that companies could reinvest the money, Mr. Diamond, can you explain how you're investing that $3.7 billion growing your company, and are you using it to increase pay for your workers and reduce the pay ratio?
A lot of companies, not just JP Morgan, immediately announced pay increases, more investments, more for us, $20 billion LMI lending, billions more small business lending, and because we got regulatory approval to expand our network into another 17 states, opening branches, which every time we do LMI lending, small business, charitable giving, et cetera. What we've said is that America should have a competitive tax system. It's the cumulative, long-term effect of capital retained and reinvested in the United States, which will drive wages and growth forever. That is the benefit. It was never meant to be this week or this month or even this year. And we also make the point, a lot of that benefit will be competed away. It will eventually end up in wages or cheaper prices to consumers or something like that as we all compete. And that's already starting to happen.
Thank you. But I just wanted to go back and say, I did the math on those efforts that you're talking about and you know, expanding pay for people, increasing their take-home pay. Those efforts that you're talking about total roughly $100 million. What I'd like to know is, where did the rest of the $3.5 billion go?
It's $100 million. We also did another $150 million philanthropy, and some of the number of the capital has to be deployed to support all the loans. And building the branches costs $1 million a branch, and so it's far more than $100 million.
Okay, we're still really quite short of $3.5 billion. Can you tell me specifically where a couple billion went then?
It was never intended to go immediately out. Someone went back to our shareholders where it belongs if we can't responsibly use it. Remember, the shareholders redeploy it. It doesn't disappear. So, you know, those shareholders, a lot of constituents of yours who get that money back, and then hopefully they make other investments or decisions that they think are in the better interest than me keeping capital that I can't use that year.
Appreciate that. So let's talk about a little bit of that buyback. In total, I think JP Morgan bought back roughly $20 billion of stock last year, and you've said that's because you had excess capital that you couldn't invest in growing your business, correct?
At the time, yes.
Further, you have said in your annual letter that your biggest issue is with GSIB capital requirements. I'm assuming you'd like those to be lower, correct?
They should be properly done, whatever they are. They're not properly done.
You think the level is too high or too low? What are you saying?
The level is too high because America just gold-plated it and changed a bunch of rules that make it hard to
So it should be, and that would mean you would want it to be lower. So if those were lower, what would you use that capital for?
I agree that companies should invest to grow their businesses and their people, customers, products, or that is the #1 for their company. I don't like buying back stock. I prefer to invest. When you can't use capital in the short run.
Just to mention, though, you said in your letter to shareholders that you had excess capital.
This is
reclaiming my time.
Not for next year.
You said in your letter to shareholders that you had excess capital, and that's why you're doing buybacks, because you had excess capital. So you explained to them that you were using that excess capital to put more money in the pockets of shareholders.
In the short run, but as we are growing and expanding the 400 branches, we're probably coming to Iowa. We're expanding small business lending. We're expanding just about every business we have. We are starting to use that capital, and over time, I'm hoping we don't have any excess capital.
Reclaiming my time, it just doesn't sound like you'll be investing that capital and making more loans or investing in your firm. It sounds to me like you're asking for lower capital requirements, which would increase the risk to the economy and, of course, to our taxpayers, just so you can buy back more stock. So I'd briefly just like to say that, you know, we've heard a lot from banks like yours that we can just relax this regulation or just that capital requirement because we're all in better shape right now. But we're not talking just about one regulation here. We've talked about capital levels today, but I didn't even mention now that banks have to prepare their full resolution plans just once every 4 years, or the way our stress tests have been weakened. So it's not just one area. And I'd like to remind everybody the purpose of this hearing is to look back on the past 10 years, and I hope that we don't see that happen again. I'm looking out for Iowans. Thank you.
Thank you. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank the chair, thank the ranking member for holding this hearing. You've had a long day. Thank you all for your forbearance and being with us today and for demonstrating your accountability to your shareholders and to the public trust. I want to start with a comment that Tim Sloan made and a question that I had when he appeared before the committee a few weeks ago. And it regards to something I learned over 35 years of my banking career, which is how to achieve the best platform customer service, but also know and have a daily handle on how your compliance is operating at the retail platform. And that's through mystery shopping. So in an answer to a question, Mr. Sloan reported to me that Wells Fargo did not have a practice of retail platform mystery shopping prior to getting into a world of regulatory trouble over their sales practices. And for just a country banker from Arkansas, I found that surprising because that's been a general practice among compliance professionals for years. So I just would love some comments if we could just go down and you tell me if you use mystery shopping for both purposes, achieving the kind of platform professional customer service you want with your retail client base, and that you use it to determine that you're doing a good job on fair lending and other compliance matters. Mr. Corbett?
We do use various forms of mystery shopping as well as net promoter scores after engagement contact with clients. So it is one of many things in the toolkit.
Yeah. You've got a pre and a post review process. Mr. Diamond?
Yeah, we do periodically do mystery shopping, and like Citi, we also periodically question our customers. Do they like the product, like the service? Also, we have hotlines for employees who think we're making a mistake, for customers who think we're making a mistake, and obviously respond to every regulatory issue that comes our way to make sure we're trying to do the right thing every day.
Right, good, thank you. Mr. Gorman?
We have a different business model. We don't really do mystery shopping because you have to open a relationship with a financial advisor, but we use technology, various algorithms to track the activity in those accounts to ensure that it's being done properly.
Good, thank you for that. Mr. Moynihan?
We have mystery shopping that is done routinely and has been for many years, and it is done in our compliance function and our enterprise test function, both in our risk management organization.
Good. Gentlemen?
We study our clients and our competitors very closely, both directly and through the use of technology.
We don't have branches, so we don't mystery shop.
Right.
In traditional sense.
We have a different business model. Our consumer business is very small and it's digital, just starting as a digital platform. We use a variety of surveillance and data techniques.
Thanks, I appreciate that. Mr. Gorman, with your big international footprint, and I know how complex when you think about Venezuela, Iran, North Korea, Cuba, all the financial and economic and trade sanctions that we have imposed both at the United Nations and the U.S., it's a lot to be keeping up with. So can you give us some feel for the design of Treasury's financial sanctions? Are they hard to manage inside your organization, and what could we be doing differently? And if I'd invite all of you to write me on this subject. We want financial sanctions that are strong, but we want to have it done in the right way. Would you address that?
Well, firstly, we do everything possible to ensure we're in total compliance with the sanctions, obviously. We work hand in glove with the government on that. We try not to do a lot of business in many of those jurisdictions you just mentioned for the obvious reasons. Listen, are they as efficient as they could be? I'd have to have the team get back to you on that. But we have thousands of employees in our risk management, compliance, audit functions doing that.
Please respond to that if you would. If you've got your experts could write the committee about how to better target financial sanctions for compliance. I want to end in the few seconds remaining and just address this issue of buybacks. And I want to thank Mr. Solomon for a very good research report from Goldman Sachs on this issue. I've heard my colleagues on both sides of the aisle condemn stock buybacks, and I'd like to say that capital allocation is a fundamental responsibility of boards of directors. And I looked at the statistics, and again, this is a public document, invite people to look at it. R&D spending and growth spending among the Fortune 500, it's up, and it's on par with where it's been for 30 years. So that's point one. Point two, we talk about shareholders like they're some unknown group of people. This money are American citizens, labor unions, pension plans, and 401k plans. And your report shows no correlation with CEOs manipulating their compensation using stock buybacks. I yield back.
Thank you. The gentleman from Massachusetts, Mr. Lynch, is recognized for 5 minutes.
Thank you, Madam Chair. I want to follow up on a question that was asked probably several hours ago by the gentleman from Indiana. You each responded to his question about systemic risk and the things that sort of keep you up at night. You all mentioned that shadow banking in some form was a source of risk, although a number of you said it's not systemic yet. And I recently was appointed, thank you, Madam Chair, to the chair of the task force on fintech, and I serve with my friend from Arkansas, Mr. Hill, who just spoke. We do see the trends in that area, in that space, going much more to mobile, and I know that J.P. Morgan and Bank of America are probably further down the road than some of the other banks. But it is about $71 trillion worth of economic activity that's in the shadow banking space right now. And, you know, we're always trying to, especially on this task force, trying to balance the need for innovation and creating conditions that will allow innovation to occur, yet also protecting the consumer. You know, we've seen some disasters with Mt. Gox where $350 million worth of, you know, Bitcoin disappeared, no FDIC insurance. Those people just lost out. $72 million on Bitfinet, same deal, you know, unregulated area. So if you were us, okay, and you were going to focus your energies on shadow banking and how we might diminish or mitigate the threat of systemic risk presented by shadow banking, because it's so widespread, where would you focus? Where would you put your energies? What do you think would best serve the consumer while, as I said before, you're trying to balance this, this need for innovation as well? So I'm not sure. Mr. Moynihan, would you like to take a crack at that?
Sure. I think some of my colleagues have mentioned earlier, I think of two things. One, when we talk about shadow banking and the risk, from a lending perspective, it's over-lending, people over-borrowing and the damage it creates when that happens. That's one side. And then the second thing is the payment system, because at the end of the day, as you said, $71 trillion or some big numbers moves through electronic transfer of value. And if we lose the integrity of that, everybody could stop doing it. It just would change dramatically how we'd have to rebuild the system of receiving cash and moving cash and merchants taking cash and everything if anybody lost faith in it. So I think I'd look at payments and I'd look at types of loans where you're worried about leverage by consumers and companies, and we mentioned those types earlier.
Yeah. Mr. O'Hanley, on the payment system side, is there something that we could be looking at?
I think you need to recognize that probably some of the best innovators in the world are the institutions sitting right here. Right. But right now, they're often held to a very different standard than some of the fintech firms. I think you want to be encouraging fintech, not discouraging it, and encouraging it here, not just in the private equity space or in places where that's outside the system. So in my mind on payments, it's an activity. You ought to be looking at the activity, irrespective of whether a bank is doing it or whether a non-bank is doing it.
All right. Mr. Diamond?
Well, we've spoken before about calibration, about how you set rules so you know where the things are. People define shadow banking differently. It says $70 billion. I think that includes money market funds and leveraged loans and maybe even ETFs, et cetera. They all need, in the financial system world, you need to be analyzing all of them all the time. There will be things you don't know how they develop over time. You've got to be prepared for. There are interconnections that you probably don't put in that category, exchanges and clearinghouses and, you know, which pose other types of things. There are federal government services that pose a lot of risk to banks. Right. So we look at all those things, but if you're talking about specifically shadow banking, student lending, which is government, it's 100% government since, I think, 2010, mortgages, leverage loans, and maybe certain types of leverage vehicles that do cause an issue if something goes wrong.
Okay, thank you. No one mentioned risk of clearinghouses when you were asked about what keeps you out at night, what keeps you up late. Is there any concern that sort of the risk that you used to be presented with is now shifted to clearinghouses? Is there a concern out there that you know, the failure of a major counterparty or a clearing member could cause a major disaster?
Just quickly, yes, we concentrated the risk in the clearinghouse.
Right.
And we all monitor that, track it, have people there and check. I think we're okay, but it has to be constantly monitored too.
Okay. Thank you, Madam Chair. I yield back.
Thank you very much. The gentleman from West Virginia, Mr. Mooney, is recognized for 5 minutes.
I appreciate y'all being here. I know there's been a debate in this country of what is the best way to run the economy in America. There are some who promote various levels of government regulation. There's some who want to go all the way to socialism. Some who believe in free markets and capitalism, which is where I line up. And I think some of my friends on the other side of the aisle have criticized, well, I know they've criticized buybacks, dividends, and other ways that banks allocate their capital. In my view, that criticism misunderstands both the reason for and the effect of this type of capital allocation. So my question is going to be, it's a long question and anybody can answer. I know companies allocate capital in several ways, including by expanding business lines, investing in research and development, and returning money to shareholders via stock buybacks and dividends. Companies tend to return capital to shareholders when they do not have a more optimal or immediate business need. So can you describe how your institution approaches decisions regarding capital allocation and why, in cases where you have returned capital to your shareholders, you opted to do so?
Happy to start that, Congressman. You know, we set a budget every year. We determine what we're trying to do with the business. That business drives certain capital needs, whether it's the growth of the balance sheet, various investments. And then to the extent we have excess capital, you have some choices. Are there new businesses you want to enter into? Are there businesses you'd like to acquire? And shareholders properly paid for their ownership of the company. And they can be rewarded through dividend increases, which is reflective of growth of the company, or through retiring shares, which is what the buybacks do. Just give you one number. Pre-crisis, we had 1 billion shares outstanding. Post-crisis, we had 2 billion shares outstanding through various share issuance over a period of time. We have now bought back 300 million shares, so we still have 70% more shares outstanding than we had pre-crisis. So the buyback is something that the owners of the company are expecting at different points.
Anyone else? Salman?
I think, you know, capital allocation is a complicated process, and one of the things that Mr. Gorman was highlighting, that you're highlighting in your comments, is that you have to plan, and the timing of that plan is different. You've got timing around your regulatory process, around the capital you have to hold. You have to make investments. Investments are made over numbers of years. You have market changes that change, you know, what opportunity sets are. And so one of the things that you're trying to do is you're trying to balance all these things. It would be easier to balance them all if there was more clarity on the capital that you were going to need going forward. But one of the things that we as an industry wrestle with is having to leave buffers or cushions and then obviously deal in the aftermath with how we want to choose to return capital. We've been making significant investments in a new consumer platform. Last year, we invested $600 to $700 million in building that consumer platform. Last year, we actually bought back less stock than we did the year before. And we'd all rather, and Mr. Diamond said this earlier, have lots of opportunities to continue to invest as opposed to return capital. But it is our job to balance, because it is our shareholders' capital, dividends, stock buyback, investments, and the capital that we have to hold, you know, as a regulated business. And that's a complex matrix.
Okay. Well, thank you for the answer. Before I run out of time, Mr. Gorman, when you spoke, I heard your accent, and I'm chairman of the Congressional Rugby Caucus, so maybe at a different time you and I can talk some rugby. And I really enjoyed that sport, played it at Dartmouth College very competitively. Thank you for your time. I guess I'll go ahead to the second question. When a company buys back shares or pays higher dividends, those resources do not disappear. Instead, shareholders deploy that capital in the economy, including through investments in other companies, which may in turn hire additional workers or produce additional goods or services. This type of capital allocation is a critical source of funding for entrepreneurs, small businesses, and other emerging companies. Anyone want to elaborate in the last 45 seconds here on how buybacks and dividends benefit the economy?
At the end of the day, I think all of us would agree, if we have any use of capital, we can deploy it above our cost of capital, our shareholders, we're going to do it, because that's our job. The minute we don't have it, we'll give it to someone else who will deploy it to put it together, to put it to use at their cost of capital. It's the way the system's worked. It's worked like that forever. This is not a new concept.
It's probably what's made us the greatest economy the world has ever seen. Thank you, gentlemen.
Thank you. The gentlewoman from Pennsylvania, Ms. Dean, is recognized for 5 minutes.
Thank you, Madam Chair. And I want to start by saying thank you for being here. Thank you for your time and your thoughtful answers. And I want to commend those of you whose enterprises have chosen to make a difference in terms of gun violence in this country, and who have chosen to reduce, if not eliminate, lending. You have an important role to play. Your voice, what you do, has an important role to play to make this a safer world. So I would ask the rest of you to also reduce, until you find gun manufacturers far more responsible than they are today, that you would reduce or eliminate your lending in that area. Two things I'm concerned about. The analysis of the title of this was to look back on the global systematic important banks 10 years after the financial crisis. I'd like to look at the other side of the table. So I'm happy that each of you came in, and each of you, I think, is reflecting that your enterprises are healthy, that you are profitable. But let's look back and take a look at the other side, the consumer. So one area that I'm concerned about is credit card transparency and fees, and how a lack of transparency hurts consumers, hurts customers. Last year, Citibank entered into a $335 million settlement around credit cards. Could you tell me what were the bad practices that resulted, and specific, so it's real to me, a credit card holder, what were the bad practices that you recognized that you had undergone in winding up settling for $335 million only last year?
We look at where that came from, Congresswoman. It came from the implementation of the CARD Act back in 2010 and 2011. And in there were formulas to give rate reductions to customers over time based on certain criteria. It was a fairly complicated set of applications, and candidly, we got it wrong. We self-discovered it, we self-reported it, and we went back to our consumers and made reparations for it. To put that in context, we got it 90% right. 90% right doesn't work, right? We should have reduced and lowered by $3.3 billion, and we did it by $3 billion. So
to the individual cardholder, what did that mean?
So that meant that we charged them more than they should have been charged in the form of rate, and we went and gave them all of that back.
So an enterprise as large as yours allowed that to go on for how long?
The CARD Act was implemented 2010, 2011. It was discovered in 2015, 2016, reported, and then remediated.
So overcharging for 4 or 5 years.
Correct.
$335 million. I'm also very interested, and I have a personal experience with this, and it is the home modification program. And I think, I don't know if any of you have had this experience, but I've actually sat with family members and constituents. I was a state rep before I got here in Pennsylvania. And I've sat with constituents and family members as they're struggling for a mortgage modification or facing foreclosure. And I wanted to ask you, Mr. Moynihan, have you ever had that experience?
I have not sat with someone who's going through the modification process. We built centers so that we could engage with people. And
I traveled to one of your centers in Pennsylvania.
And
my family member, before getting to the center, faxed in their materials, if I'm correct, 11 times. And each time was told, oh, we lost a page, or we didn't get it. My family member also went, because you had convention-like meetings, went to Baltimore to no avail, until I got on the horn with your company. And it took dozens and dozens and dozens of hours to get any satisfaction. I don't know how people actually would endure that, because you also know the shame and the fear that comes over a family when they are losing their home.
We did a lot of them, and so I apologize if your constituent at the time was treated right.
You saw you have lawsuits against you for this same practice,
right?
Over and over again. It was not just one person.
And we had a settlement like all of us did. We did everything on that settlement. An independent monitor looked at it and said we were in full compliance.
How many people lost their homes?
The precise number of people lost their homes in America was around,
Your borrowers, how many of your borrowers lost their homes?
the total foreclosures done over since '06 when housing costs quit going up on pieces of property were probably around 1 million.
1 million of your customers lost their homes,
And 2 million were modified.
and 2 million modified. Did you ever take the time to meet with some of those folks who lost their homes?
I received emails from them. I ensured, when I met with Senator Reid, and he asked us if we could open up centers. We opened up 26 centers. We put on 50,000.
Can you explain to us what the HAMP program did? What monies did you get to modify mortgages, and yet 1 million went into foreclosure and lost their homes?
I know there was great discussion about that. But the amount of money that we got to do HAMP modifications was the incentives to do them. It was nothing compared to how much
I want to make one final point, if I may.
I'm sorry, you're way over your time.
I'm over. Okay.
I'm sorry.
Thank you, Madam Chair.
Yeah, thank you. The next person is Mr. Garcia from Illinois, recognized for 5 minutes.
Thank you, Madam Chair, and thank you all for being here. The largest financial institutions of our country. Let's talk about a very small island in the Caribbean and some of your business practices. Mr. Gorman, I'll begin with you. The Public Accountability Initiative issued a report earlier this year which noted how, in January of this year, the Financial Oversight and Management Board and the Unsecured Creditors Committee argued in federal court that $6 billion of Puerto Rico's general obligation debt was issued illegally in violation of Puerto Rico's constitutional debt limit. And that was a quote. The report found, quote, the underwriters on the deals included a who's who of big banks, including Barclays, UBS, Santander, Morgan Stanley, end of quote. Bank of America, Merrill Lynch is also cited in the report as an underwriter. Furthermore, the Oversight Board for Puerto Rico issued a report by Cobre and Kim that stated that Banco Popular, Popular Securities, underwrote the 2014 general obligation bond even though they did not think Puerto Rico could repay it. Mr. Gorman, did Morgan Stanley know at that time that Puerto Rico could not pay back its debt?
Congressman, unfortunately, I'm not familiar with the exact facts around the underwriting. I'd certainly be happy to get the details to you rather than guess at it. We have a global underwriting business. We're typically one of the top 1, 2, 3, 4 underwriters in the world. And
okay, you don't know. Thank you.
No, I do
Did
not.
you know that Puerto Rico's constitution does not allow the use of bonds to balance its budget?
I'm not familiar with Puerto Rico's constitution in detail, Mr. Garcia.
Yet your colleague from Citigroup here did know that and refrained from participating in that endeavor. It makes me really, really think. Why did you go ahead and underwrite the 2014 general obligation bond offering?
Well, I believe we've done a bunch of underwritings across all of the municipalities and states and territories of the United States for many, many decades, including Puerto Rico. I'm just not familiar, unfortunately, Mr. Garcia, with this particular underwriting.
Mr. Gorman, when you sold the 2014 GO bond, Puerto Rico already had about $65 billion in debt outstanding. Were you aware of that?
Again, I'm not familiar with the details of the Puerto Rico economy at that point in time. I'm happy to submit what information we have for your benefit, Mr. Garcia.
Isn't this type of information for potential investors, institutions like yours who want to do business in a particular place available to all, like a credit report would be?
No, it certainly is, and the information would be available within Morgan Stanley. As the chief executive, I can't be responsible for understanding all the details of everything.
Let me ask Mr. Moynihan then. Mr. Moynihan, would you commit to returning the $13.1 million or more that your firm collected in fees from illegally issued debt to the government of Puerto Rico as underwritten by Bank of America Merrill Lynch?
Sir, I'm not familiar with the transaction you're talking about. And I'd be happy to get back with you in your office and we could take you through it, but I'm not familiar with that.
Did you disclose that Banco Popular, who joined you in the underwriting, the offering and Citigroup's action or refusal to participate, though Puerto Rico in 2014 couldn't pay back those bonds?
Again, I can get the teammates who worked on it to work with your office. I don't know the facts.
Did you underwrite these bonds because the market wanted triple tax exempt bonds even if the government of Puerto Rico couldn't pay them back?
Same question. Sir, we can get somebody who understands the details of this underwriting. If we in fact participate in it, I'll get some.
I'm trying to help the American public look back 4 or 5 years ago and understand some of the actions of our biggest institutions, financial institutions in this country. I think the American people want some answers about this. This isn't that difficult to know. It didn't happen that long ago.
I'm happy to give you answers, I just don't know them off the top of my head.
This is very disappointing, and I would expect that that information isn't that difficult. It's been written about significantly lately, and the American people deserve better. Thank you. I yield my time.
The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair. And first, let me thank you for calling this hearing on this very important topic. Gentlemen, thank you for your patience and your endurance. I know that all of us came in not expecting such a long hearing, but that is part of the process in giving the taxpayers and the public their right to know. I know it might seem like we brought you here today to be grilled on a whim, or as someone suggested from the other side of the aisle, to make headlines. But no, you are here because you run banks that are so large that their failure represents a potentially systematic threat in the global banking system. People remain angry that institutions you represent endangered the national and global economic stability a decade ago. They remain angry that you received taxpayer-funded bailouts while they were left owning mortgages worth more than their houses and got no relief from Washington. And frankly, they have a right to be angry, because you know what? I'm angry too, and I know many of my colleagues here in this hearing room and in Congress are also angry. We're angry about that, and we know how your institution seems to have fully recovered, boasting record profits, while many people in my district are just now feeling like they have gotten back to where they started. And then, of course, Harvey hit and other emergencies have arisen. So, like my colleague, Ms. Dean, mentioned, you know, I want to talk about the other side. We know you all are doing well. We can see that. We've seen a lot of reports that suggest that. So I want to talk about the consumer. And one thing that I always get really concerned about is the fees. And Mr. Moynihan, I was particularly concerned that of all the complaints that I got during the unforgivable shutdown, that some of my TSA workers in my district had the biggest problems with your bank, Bank of America. In fact, one worker relayed to me that not only did she have past due notices and extra charges for that, but both her car loan and her mortgage, that both were from Bank of America, that she could not get anyone to listen to her about either suspending collection, forgiving the fees, or altogether helping her out. And it took me having to call someone locally after trying to get through someone here in Washington through one of your lobbyists. I must say they never did return my call. But because I'm a former state senator, I did visit with my state governmental folks, and they quickly helped us resolve that issue. So why is it that for some consumers, much like she had to work with her family as a state rep, I mean, why do they need a member of Congress to help them talk to a bank? Can't you all be just a little bit friendlier?
So first off, I apologize that anybody went through something. We helped 24,000, we had 24,000 calls. We had 14,000 people we gave relief to. We treated it as a national disaster. The relief lines were open up until the end of March. And so 24,000 people, we stepped up and helped through mortgage forgiveness, auto payment forgiveness, zero interest credit card loans for 6 months that they could pay back.
Do you do that for all natural emergencies?
We do that for all natural emergencies. We did it for the hurricanes. We've done it for many things.
Oh, that's great. I just want to hear from the other retail bankers. Does Chase do the same thing?
Absolutely. We actually can identify who a lot of these folks are. Government shutdowns, national emergencies, we forego fees, we forego certain types of payments. We put payments to the end. Okay.
Just a yes or no, because my time is running. What about Citibank?
Yes, government workers and government contract workers.
All right, there's always a lot of fees, so I just want each of you, and I'm going to start with you, sir, because you always get the tail end. We're going to do reverse. What % of your revenues is fees?
Our consumer business is tiny in the scope of
Well,
Goldman
what
Sachs.
about custodial fees, safekeeping fees?
It's tiny. It's not, they're not businesses.
Well,
that
how
work.
tiny is tiny? Because tiny for
Less
you
than-
may be millions, and that
less
is
than-
not tiny to the average consumer.
The kinds of fees you're talking about, I believe less than 1% of our revenue.
Less than 1%, Mr.
Well, I think total fees are something like 2/3 of our total revenues, but we don't have a consumer business.
You were talking about consumer fees,
Right,
correct?
consumer fees.
Less than 1% of our business.
We don't have
Mr.
a
O'Hanley?
consumer business.
All right, Mr. O'Hanley,
We have no consumer business.
Mr. Monahan,
Consumer fees and the consumer overall revenues are probably, I'd say, less than 5% of our total revenue in the company.
5%, Mr. Gorman?
I don't know, but I would estimate approximately 2%.
Okay, Mr. Diamond?
I just don't know the number offhand.
I'm sorry?
I don't know the number offhand.
You don't know the number,
I'd be happy to give it to you.
Corbett?
It's in our fully disclosed documents, but I don't remember.
Mr. Corbett?
A de minimis amount, very low single digits.
All right, thank you, I yield back.
The gentleman from Minnesota, Mr. Phillips, is recognized for 5 minutes.
Thank you, Madam Chair, and thanks to each of you for providing jobs to over 500,000 Americans and credit to millions of enterprises, large and small, both in our country and abroad, that create millions of more jobs. And I want to take our few minutes together to seek your advice and counsel, if I might, starting with the fact that in our nation, almost 50% of our wealth is concentrated in the hands of just 1% of our population. 20% of annual income accrues to just the top 1% of earners. Most of the CEOs of the S&P 500 companies, including each of you, earn anywhere between 100 and 500 times more than the median earners at the respective businesses. And every one of these indicators is moving in the wrong direction, in my estimation. So I have two questions, and I want each of you, if you would, just take about 30 seconds to answer. The first is, do you believe that our growing wealth and income disparities pose an economic and social risk to our country? And if so, what can you each do, and what can we do here in Congress to address it? Starting with you, Mr. Solomon.
I do think that income disparity is a real issue. It's something that both the public sector, you in Congress, and we as private companies have to work to try to contribute to. With respect to our organization and our employees, we're a little bit different than some of the discussion that's happened. We're an institutional business, and so we don't have minimum wage employees. The average compensation, for our employees across our 36,000 employees is much, much, much higher.
Now, we don't have much time, so how about one thing that we can do, one policy?
I think we've got to continue to try to make investments to create more opportunities. So one of the things we're doing is we're going into underserved communities, and we're making investments in housing and community infrastructure and other programs that support underserved communities.
Thank you. Mr. Sharp.
As I said before, we don't have a consumer business, but we, as a company, do everything that we can through our community lending programs, where we have employees. And I think we feel we do that because we have an obligation to do that. I think just from a policy perspective, looking at the underserved and looking at things like access to credit and housing are two important topics to take a look at.
Thank you. Mr. O'Hanley.
I believe there's an income and wealth inequality problem in the U.S., that it is getting better. I think that what you, Congress, can do is take a look at the retirement system. The access to retirement system is very limited today. Congress hasn't really looked at this in a comprehensive way since 2006.
Okay. Thank you. Mr. Moynihan.
We continue to work hard on the issues you raised. First, we have responsibility through the banking system to serve LMI communities. We have about 31% of our branches are in LMI communities. We agreed we'd hire 10,000 new teammates from those communities. We're probably halfway through that, moving through the pace for 5 years. The way we structure fees and products and services, affordable housing, $4.7 billion of lending into affordable housing and community development at the local communities last year. Business formation, as I spoke about. And then I think on how to manage your money. We had a thing called Better Money Habits. It's had multiple billions of dollars of customer views. It has helped over almost 900,000 people. Those people save more. Those clients save more. They handle their finances better. That is a major program with Khan Academy. And so
I hate to cut you off, but I want everybody to get a word in. But do you think it's a problem?
I think it's a problem we can solve if we work on it. I think what I'd ask you to do is we look at this with CEOs and the business community. It's transportation, housing, and education alignment. Those three things just have to be.
Thank you. Mr. Gorman.
It's absolutely a problem, not just here, but in most developed countries in the world, and it's not going to be solved easily. You have three weapons, effectively. You have tax policy. We have a graduated tax policy. You have subsidization of lifestyle through education, healthcare, transportation, housing. But most importantly, you have opportunity for economic growth. So what you can do is help businesses drive and grow, and the U.S. economy keep being the strongest economy in the world.
Thank you. Mr. Diamond.
Yep, absolutely, it's a problem, and it is a global problem today, and we need to study it and have the right policies. If I was going to name one or two, infrastructure and education. Education is CTE training, community college, apprenticeships. It works, it works, it works. There are a lot of good paying jobs going unfilled.
Thank you. And Mr. Corbett.
Absolutely, Congressman. It is a problem. I would say financial inclusion and financial literacy in today's age in our economy, in this country, the fact that we have 25% of our population who lives somewhere between unbanked and underbanked, with the technology resources that are out there, it's a fixable problem.
Thank you. I'll close by extending an invitation. That is to ask each of you to help us be part of the solution. We need you. Thank you.
The gentlewoman from Massachusetts, Ms. Presley, is recognized for 5 minutes.
Thank you, Chairwoman Waters. I appreciate your continued leadership. More than a decade later, we are still grappling with the consequences of a crisis created by greed and complete and utter disregard for the welfare of everyday Americans. And yet, the narrative has shifted from a focus on Main Street's suffering to a celebration of Wall Street's recovery. In the district that I represent, the Massachusetts 7th, a study by the Pew Research Center shows that from 2005 to 2009, median wealth among Hispanic households fell by 66%, by 53% among Black households, 31% among Asian households, and by 16% among white households. These families were often the target of subprime lending, yet have never been repaid. Your bank shareholders are reaping record profits while there is little evidence these lower income individuals and communities of color are anywhere near close to recovering. In fact, just yesterday, we were discussing the ongoing prevalence of redlining and other discriminatory practices, despite the fact that 98% of banks are passing CRA examinations. This is exacerbating the wealth gap in Massachusetts and across the country. Today, I want to dig a bit deeper and resurface a report from 2016 which addresses pink lining. Are any of you familiar with the phrase pink lining? Well, women are 30 to 46% more likely to receive subprime mortgage loans during the financial crisis than men. And Black women were 256% more likely to receive subprime loans than white men. 256%. Mr. Diamond, you co-wrote a piece recently entitled Advancing Black Pathways and spoke about how you wanted to address the racial wealth gap. That is wonderful. But what's even better than an op-ed is action. So for the purposes of the record, could you clarify, in 2017, J.P. Morgan agreed to a $53 million settlement with the DOJ pertaining to allegations of what?
You don't recall?
Reclaim, okay. Discriminatory mortgage lending practices. In the time since, what tangible changes have you made to your bank's lending practices?
We don't redline. We do a lot of work to make sure we don't. In the auto business, in fact, we do reverse redlining. We try to make sure that we reduce people's rates based upon that Bayes calculation that gets done. If you ever have a problem, I think we did let us know. And we also want to use AI. Not only AI can be biased, but you can also use AI to try to do more lending mortgages to the Black community.
You spoke earlier of a number of community lending initiatives, Advancing Cities, that was your testimony?
Yes.
Correct? Okay. And I'm glad you mentioned that initiative. I think, correct me, was the amount $500 million?
Advancing cities is 350 million over 5 years.
One more time?
350 million over 5 years.
350 over 5 years. It sounds like a lot of money for community groups that are eager for funding. However, comparatively, it doesn't sound as generous when you think about the fact that over $43 billion have been paid by your bank in fines in just this decade since the financial crisis. So, Mr. Diamond, is it possible you have just decided these fines are the cost of doing business the way you want and not the way that protects consumers?
Absolutely, positively not. And I just want to point out that a large bulk of the mortgage-related stuff was Bear Stearns and WAMU, which we bought at the request of the United States
Claiming
government.
my time. Moving on, I want to quickly touch on another issue hurting our communities. While many banks have chosen to forego overdraft fees, Bank of America, Chase, and Citigroup still cling to these practices. Mr. Corbett, would you say that overdraft fees are a core function of your banking business?
No, they're not.
Mr. Moynihan, are you aware of what percentage your total revenue in 2018 came from these fees?
From overdraft fees?
Yes.
Probably less than 1%.
Okay, so if the answer is less than 1% or 2%, but for a family in my district hit with a series of overdraft fees, that is the difference between a tailspin and getting by. So your banks pay billions in fines dismissively, and you have convinced yourselves that overdraft fees that make up less than 2% of your revenue are essential to bank operations. If you can write off billions of fines at the cost of simply doing businesses, how are overdraft fees anything other than an ideological tool to simply further punish the poor? I'm appreciative of what you've shared here today relative to your community programs and development funds, but this does not shield you from criticism about discriminatory lending or the fact that many of you continue to practice, to put into practice overdraft fees, further punishing the poor.
The gentlewoman from New York, Ms. Ocasio-Cortez, is recognized for 5 minutes.
Thank you, Chairwoman Waters. And thank you all for joining us here today. I know it's been a really long day. The purpose of this hearing is to review globally systemic banks 10 years after the 2008 financial crisis. So just know that while I'm tough, it's not personal, okay? I was really going back and reviewing these last 10 years, and I have concerns about how much things have really changed. I did an assessment, and year by year, let's go back to 2013. 2013, Chase had to pay out $720 million in fines to the Fed, SEC, and UK Financial Conduct Authority for failing to oversee its trading practices, including what is known as the London Whale. 2014, Bank of America agreed to a $16.5 billion settlement to the DOJ and others for misconduct related to mortgage-backed securities, and a $20 million penalty with another $727 million in consumer relief. 2015, Bank of New York Mellon, $714 million to settle claims that it defrauded customers when it promised to exchange at best rates for customers, but instead used the worst rates and pocketed the difference. 2016, Wells Fargo entered into consent orders for fraudulently opening millions of accounts in customers' names without their consent or knowledge. 2017, State Street, 7 months after installing the Fearless Girl statue, paid $5 million in back pay and interest after a Department of Labor audit found that State Street was systematically paying female employees less than their male counterparts and black executives less than similarly situated white executives. My colleague from Illinois highlighted some troubling connections between Morgan Stanley and Puerto Rico's illegal debt load. 2018, Goldman Sachs began facing lawsuits from DOJ, the Fed, foreign governments in relation to funding bribes and kickbacks to foreign officials relating to raising funds for Malaysia's sovereign wealth fund. Timothy Leisner, the Goldman Southeast Asia executive, pled guilty to various charges and forfeited $43 million. And just last month, March of 2019, Citibank fined for $25 million for violating the Fair Housing Act, for failing to offer benefits to all eligible customers, namely on the basis of race, national origin, and sex. And so I'm concerned here about the potentiality of fines related to misconduct just being incorporated as the cost of doing business. Mr. Corbett, is a cost-benefit analysis that weighs the cost of government fines versus the potential financial upside of potentially breaking the law, does that factor into controversial decision-making around misconduct at your bank?
Absolutely not.
Okay, in my district, I represent Rikers Island. I represent kids that go to jail for jumping a turnstile because they can't afford a Metro card. Do you think that more folks should have gone to jail for their role in a financial crisis that led to 7.8 million foreclosures in the 10 years between 2007 and 2016, Mr. Diamond?
I don't think people should go to jail for jumping a subway. I think we put too many people into jail, and I think if people broke the law, they should go to jail.
Mm-hmm. Okay. Do you think that the failure to hold more people accountable for the 2008 crisis is a failure of our legal system?
Look, you have to talk to a lot of legal experts about why more people didn't, whether they deserve to, whether they broke the law, what's intent, what's not intent. But you have to talk to legal experts about that.
On that note, Mr. Diamond, I do want to commend you for your decision and Chase's decision to pull out of financing for private prisons. I think that that has led to some changes, particularly with Wells Fargo as well, in making sure that we begin to divest from some of the troubling things that we're seeing, particularly when it comes to the caging of children at our border. I have one last question with respect to this more future-looking. Recently, the Federal Reserve Board decided not to activate the countercyclical capital buffer this year, but banks are very profitable, making a record $237 billion in profits last year. Mr. Corbett, is this not the best time for banks? Is this not the best time for the Fed to build more capital so that they can be in a better position to weather a future downturn?
As I stated earlier, that today, by the Fed's own measurement, they're measuring 23 or 24 different types of capital. What we've said is we're welcome to a holistic approach, of which the countercyclical buffer is one, but rather than pick individual, let's look holistically at what the right solution is.
The gentleman from New York, Mr. Zeldin, is recognized for 5 minutes.
Well, thank you, Madam Chair, Ranking Member McHenry, all of our witnesses who are here. I represent a district on the east end of Long Island, the 1st Congressional District of New York. There's a lot of strong representation on both sides of the aisle from our home state of New York, and I see that a majority of the witnesses who are here from companies that are headquartered in our home state. Being the nation's financial capital and a global hub for banking and investment, however, could be slipping away because of bad policies and hostile rhetoric that has consequences. Over the course of the hearing today, there was some discussion with regards to the pending Brexit. Many of your firms have already moved operations out of London. We're seeing a massive loss of jobs and investment in New York, most recently as Amazon and its potential 25,000 jobs were chased away from our area. There are consequences to bad policies, and there are serious ramifications for global competitiveness when local, state, and national lawmakers continue to take such hostile and anti-business postures. I think the consequence with regards to Amazon leaving is not just the 25,000 jobs, but all the other jobs that would have been supported, the infrastructure to create the headquarters, but also other businesses in the financial industry have said that back and forth that took place has impacted their decision to come here. I wanted to touch on one thing that Ms. Porter had discussed. And I actually wanted to say thank you to Mr. Diamond with that exchange, because in that example in California, that woman was given an opportunity by JP Morgan Chase that no other business in that community was going to give an opportunity to at all. So this woman who has bills to pay and has a young kid now has an opportunity to enter the workforce and work their way up the workforce and have a job where no other company there in that community would have given that opportunity. And if that person needs to achieve, they want to achieve the American dream and they need to get a car, you'll help finance it. If that person wants to be able to own a home to achieve the American dream, they're going to come to you to be able to afford to finance that home to have the American dream. Maybe they want to start a business and they need capital in order to start an idea that can grow into something bigger. They'll come to you, and that's how they'll achieve their financing in order to hopefully achieve the American dream. It's important to be able to provide the best possible opportunities for people to get out of their tough situation. They're going to have to fight hard and work hard, but what we don't want to do is see those jobs get replaced by automation. And where I'm from on Long Island, as we've seen the minimum wage in New York go up, there are a lot of different entry-level positions that have gotten replaced by kiosks. Certain fast food restaurants, there are certain restaurants where you used to have a busboy, used to have a server, and now they're getting into the Panera Bread model. And I remember being at a recent State of the Union address, one of the last ones that President Obama gave, and he was talking about the minimum wage. And he was saying you can't work full-time and make, I forgot the number he said, it was $30,000 or $40,000. I remember thinking to myself, gosh, where I'm from, you can't, if you're making $50,000, $60,000, $70,000 a year, you're struggling to make ends meet. And I think what we have to be careful with regards to setting a minimum wage in that different regions of our country, if you're going to be responsible when you hire that person to be able to take care of all of their bills in an entry-level position, maybe that job won't be available to them at all. We had, during that break while Ms. Porter was speaking, I took a couple minutes to look through some of the benefits of working at JP Morgan. And I was looking at health insurance, dental, vision, 401ks, life insurance. There was child care benefits, there were pre-tax benefits to take care of expenses, and the list goes on. And I think it's unfair to come here and to be grilled like that when you're the only one in her hometown providing an opportunity to that woman. One last quick piece about overdraft fees. It's worth noting that if you don't have overdraft fees, what's going to stop people from overdrafting their account? Just saying. I mean, I understand the concern that's out there with regards to overdraft fees. But it's also very important to note that if there are no fees at all, the people are just going to take as much money without penalty out of their accounts. But I thank you all for being here and helping my constituents achieve the American dream. I yield back.
The gentleman from Colorado, Mr. Perlmutter, is recognized for 5 minutes.
Gentlemen, thank you for being here. I promise never to be late to a committee meeting again because you're put at the end of the line. Anyway, welcome. Thank you for your stamina. Thank you for your testimony today. And I want to pick up where Ms. Ocasio-Cortez left off with you, Mr. Corbett. I'll start with you, Mr. Diamond, because you and I have had this conversation a little bit about capital. And I agree with your analogy when you talked about, when you got the money, repair the roof. And I'm going to say, when you got the money, build the capital. So I do want to give you a chance to talk to me about capital, but I'm going to be a hard sell because I've been through the REITs, I've been through the savings and loans, I've been through the oil and gas banks failing, and I've been through what we went through in 2008, and Mr. Foster described it perfectly. What we were contending with and what you were contending with. So talk to me about capital for a second, and then I've got some questions about cryptocurrencies, gap insurance, and maybe marijuana and banking.
Folks mentioned there are many capital measures now, so we're constrained by this whole set. But you have to understand that CCAR, which constrains a lot of the banks, has a capital buffer in it. That's what the stress test is. It shows how much capital you retain after that stress. And I've mentioned that in the system today, all those stress tests would cost $100 billion. It would never happen that way, and it would never cost like that. But the system has almost well over $1 trillion of capital, $2 trillion of capital. And so there's a lot of capital, and we double and triple count it. That's all it is. No one's against the concept.
I think all of us would be willing to sit down and talk to you about where you think it's double or triple counted. But again, as kind of a depression baby, I'm going to be a very hard sell to chip away at that capital in these good times, because we know if we have another cycle, we're going to have bad times, and it's going to get gobbled up if you continue to do the business you've been doing and extending loans and things like that. So we know that. I do want to talk about 10 years after. And Mr. Solomon, I feel bad. You always are sort of left out, you guys at the end of the table. You know, we did TARP. You know, we did TARP as kind of an emergency.
We want Lloyd back.
Okay. We did TARP as kind of an emergency measure. We did the Recovery Act. March 9th, and there's a whole story behind that, 2009, the stock market turned, and then we did Dodd-Frank. Now, my question to you, if Mr. Kasten would move, you come late, you get to trouble here. My question to you with respect to Dodd-Frank, would you say that the system, the overall system, and Goldman Sachs became part of the system during that period of time, is safer and more sound than it was before 2008?
Yes, I agree that the system is safer and is more safe and more sound than it was in 2008, and Dodd-Frank has made a meaningful contribution to that.
Okay, Mr. Scharf.
Yes, absolutely.
Mr. O'Hanley.
Yes, it is safer and sounder.
Mr. Moynihan, and you and I can have a conversation about capital some other time, but yes, unless you want to jump in now.
The system is more safe and more sound, and the key point that you pointed out is everybody at this table is in it. In 2007, everybody at this table was not in it, and that was one of the major problems we faced.
Mr. Gorman.
Yes, it's dramatically safer and sounder.
Mr. Diamond.
It's not even close. It's multiples.
Mr. Corbat.
Without a doubt.
One thing, and Mr. Diamond, when you and I met with several of you over the last few weeks, and hopefully this isn't proprietary information, or I'll just ask it and you can say it, but I mean, how much money actually is processed and intermediated through Chase on a daily basis, worldwide?
About $8 trillion.
And Mr. Corbat?
Probably somewhere about $5 trillion.
Mr. Gorman, you're not really in quite the intermediation business. But
We're not in that business.
Mr. Moynihan?
I think it's around 3 or 4.
Mr. O'Hanley?
In our custody and administration business, about $1 trillion a day.
Mr. Scharf?
I think it's about $1.5 trillion.
Mr. Solomon?
We're not really in the business, in that business.
I just want to thank you all for your stamina today, for being here. Obviously, we went through some very difficult times. Don't want to go through them again, but I appreciate your testimony today. I yield back.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, gentlemen, for being here and for your patience. I want to note, for example, yesterday I noticed that Bank of America had plans to raise the minimum wage to $20. I think that's a great step in helping Americans earn a living wage. And Ms. Moynihan, I applaud you, and I hope the other colleagues here will follow suit on that. But there's still a lot more that we need to do. Mr. Diamond noted, and I quote, that America should and can afford to provide a proper safety net to our elderly, our sick, and our poor. And when I think about the 12th District in Charlotte, in North Carolina, that I represent, we are really having some serious issues in terms of the affordable housing crisis. I'm sure you are aware of that. Now, someone mentioned earlier that Microsoft had pledged to invest $500 million in workforce housing in Seattle. I do support efforts to grow and expand, but I want to know specifically what the bank is doing to address the displacement of longstanding residents, and what you're doing, what the bank is doing to address the housing crisis in Charlotte.
Sure. If you globally, we did $4.7 billion last year, and we'll do a bigger amount in low and moderate income housing. We've also created a catalytic fund to help drive housing. Charlotte is one of the first deployments of that. So it wasn't just us. I run the CLC, as you may be aware of, the CEO group in Charlotte. I'm honored to be chair of it. We had 3 of us announce $70 million of equity level money, which ought to be multiplied by 10s for $700 million. It's the first major investment. Our portion of that was 20-odd million. Since that, a couple of my other bank colleagues have put in another, I think, 30 to 35 million. So we're building a fund. We brought expertise, the thing called LISC, to Charlotte and underwrote, Wells Fargo and ourselves paid all the costs of that. That group is helping do the kind of financing structures they're experts at. And with the team led by our team and teams in the city we're trying to drive, and we believe that we can make a meaningful impact in near
Okay,
term.
well, we can have some further discussions about that. Let me ask, many of you have praised the Trump tax cuts, and I'm curious about the percentage of the tax benefit savings that your bank spent on affordable housing, and if everyone can we'll just go down the row, and if you can give me an amount.
At Citi, we financed $6 billion of affordable housing, 36,000 units, and from 27 to 2018, that was a 20% increase.
Mr. Diamond?
I think the number of affordable housing, direct affordable housing, is something like $2.5 billion, and obviously we finance a lot of other housing and mortgages.
Mr. Gorman?
We aren't really in the housing business per se, but through our CRA Act, we invest in multi-purpose.
All right, Mr. Monahan, I'm going to skip you since I've already asked that question.
We're not in that business either, but through our CRA activities over the last 2 years, we put $280 million in affordable housing.
All right, the last two gentlemen.
We're also not in that business, but through our CRA activities, I believe over the past couple of years, we financed probably $300 million.
Okay. Yes, sir.
We're also not in that business, but through our Sierra activities and our urban investment group, we've invested multiple billions of dollars into affordable housing.
Let me move on and ask a question about our HBCUs. It's our historically black colleges and universities. And the fact that we know that these schools pay a higher underwriting fee to issue tax-exempt bonds compared to non-HBCUs. My question to each of you, have your banks underwritten HBCU bonds, yes or no? So we can.
I'm not certain.
Mr. Diamond?
I am not certain, but we do hire a lot of people.
We do a lot of business with them, so we'll get the information to you.
Yeah, we're not in that business, though we do hire from the HBCs.
We're not in that business.
Well, I just want to suggest that would be a good business to get into, particularly if you're interested in diversity and inclusion. That's where the talent is. That's where the diversity is, and we really need to make some contributions and some commitments to these schools. I'm just about out of time, so Madam Chair, I'm going to yield back.
Thank you very much. I have a unanimous request for closing. I would like to make a unanimous request for 5 minutes for closing, both for myself and for you too, if you desire, Mr. McHenry.
Yes, I would agree.
Thank you very much. Allow me to take a moment to thank all of our witnesses who have persevered today over these long hours to hear from the members of Congress. If you can recall, it was maybe 10 years ago when you appeared that I dubbed you the captains of the universe. And so I want you to understand that we understand that you have a lot of power and you have a lot of influence. And you have historically been able to will that influence here in the Congress of the United States, and you have been trusted, and many of our members never even questioned when you came with a request for some type of deregulation. And things are changing. Things are changing a lot. You did well with deregulation in the last Congress, and so what I have said to many of you who have come into the office, please do not overwhelm us with requests for deregulation that you really don't need. And please don't go around us to our agencies having them deal with putting forth initiatives for deregulation. I hear what you're saying. You have talked about the need for harmonization. I know there's some discussion about, again, reducing the capital requirements, a lot of concerns about Volcker and stress testing and on and on and on. But I also heard that Dodd-Frank had not created any real serious problems in terms of your bottom line. Your bottom line has been mentioned a lot today in relationship to the tax break and some other kinds of businesses that many of you have been involved in. I also was happy to hear today that there was an omission that some lines of business that you have, perhaps you do not need to have, and with the reduction of some lines of businesses, it has made management of big banks maybe a little bit easier. And so having said all of that, we're worried, of course, about redlining that's creeping back in that has been identified. We're still concerned about servicing, whether it is in-house or whether or not you're contracting. We still feel that there needs to be more training, that you need to develop fraud divisions, that many of our seniors who were victims of fraud during the meltdown were not dealt with by the banks because we have not seen any real efforts by the bank to deal with fraud, where people call and they're trying to get a loan modification and they say to you, I did not sign that. That was forged. Well, nobody was able to take care of that for them. And so you have your concerns, we have our concerns. We've talked about today about making sure that there's diversity and inclusion, and you've been asked to submit your plans or your description of what you do on this issue and who that person or persons report to, on and on and on. And so we've had a good exchange today. I hope that you feel that we've been tough on you because we have. And I started out this hearing with the amount of fines that have been levied on you. We would like to see that absolutely eliminated, reduced, because every time there's a fine, it means that you have broken a law, you have done something that you should not have done, somebody has been harmed. And so, having said all of that, I'm going to ask you in all that you do to think about all that student debt. And I know that you sold the debt and you're not involved with student loans anymore, but we have a whole population of millennials who are out there who are still the victims of the debt that was incurred because they were trying to get an education. I'm asking you if you can come up with a creative product of some kind to deal with this population of millennials who can't buy a home, who can't get married, who can't buy an automobile, who don't have insurance, on and on and on. I think you, the captains of the universe, are smart enough, creative enough, and understand this business enough, despite the fact you have sold off that debt. It's not your responsibility to see what you can do about these citizens, these young people whose lives will not be, well, the potential will never be realized unless they can get out from under this debt. I don't know what it is. I don't know how you're going to do it, but I'd like you to think about it. And next year, when you come, I hope that you can give us some answers. And I promise you, next year when you come, I will not have all of you come at one time. I'm going to divide it up because it's been a long day for all of you and for all of us, and I think we can do better with the timing. With that, I yield to Mr. McHenry.
Well, I thank you, and I appreciate the opportunity to close off what has been a rather lengthy day. Thank you for testifying. There is the only thing that unites you as a panel is the fact that you're GSIBs, you're large financial institutions. Three of you compete directly as sort of really a full bank in the regard that the American people would think. Two of you are legacy broker-dealers. Two of you simply are custodial banks and in a very important but little understood by the American public institution. So there isn't really a unifier other than size. Now, this question of size, I think, is something that is important. As a result of Dodd-Frank 10 years ago, we have doubled the number of regulatory filings by financial regulators. Each one of you have grown your regulatory footprint of employees, of technology, of expense to comply with those regulators, massively. If you didn't, well, you probably have your own separate special hearing because you failed to comply with regulations. You haven't, you're here as a group. You're complying, there's a massive expense to your shareholders and thereby the American public and thereby the American economy for those regulations. Dodd-Frank was passed by a Democrat House, Democrat Senate, and signed by a Democrat President. I'm not going to relitigate that. That is done. 9 years later, we were able to have the first fundamental change in Dodd-Frank, Senate Bill 2155. 9 years later. Now, in the 1930s, you had the same Congress create the first Securities Act and the Securities Exchange Act. Same Congress, didn't think they got it right, came back a year later and did it better. It took us 9 years to have modest changes to Dodd-Frank. That's not deregulation. That's not massive deregulation. It's looking at dumb regulation, ineffective regulation, and saying perhaps we didn't get it right with the first draft. 2155 passed the Senate with 67 votes. It was a bipartisan vote in the Senate. And here in the House, with 33 Democrats voting with most Republicans, a bipartisan vote here in the House. Bipartisanship fixed what is the most egregious parts of Dodd-Frank. That's not deregulation. And in fact, your institutions weren't here begging for deregulation. You were here presenting facts on stuff that was misunderstood, drafting errors in the legislation, inappropriate regulations that cost way too much and didn't actually have the impact. So I think that's something to be noted. As I raised, the systemic risk questions are still very real for us. Thank you all as a panel of experts for answering those questions of import to the global economy, but most especially to our American economy. The question of student lending, let me just address this. Student lending, as a group of institutions, many of you were in the student lending business before that business line was nationalized. And when the government takes over a whole line of business and prices it in a way that the private sector is not pricing it, it has an impact. So you can see this with student lending. You can also see this with Fannie Mae and Freddie Mac and the GSEs. You're not in that business because you can't compete with a government monopoly. You're not in the student loan business because you cannot compete with a government monopoly. Which comes back to the larger issue that we're having politically. And you all have to live within this debate. And the American people have to live within this debate. And that is a fundamental debate about the nature of our markets and the nature of how we allocate capital in the United States of America. We don't get it perfectly right, but we get it mostly right. And now we have a whole group of folks saying the market does not work. The allocation of capital does not work. Free markets don't work. Capitalism does not work. And therefore, we need to nationalize other pieces of the economy. I think it's wrong-headed. I think we need to make sure that you're allocating capital in the appropriate risk setting, and that's what we should do. That's what we've done legislatively. That's also what we've done in terms of regulation. That's why we have the regulatory footprint that we do have. So thank you for your willingness to testify. I appreciate the role that you play in our economy and the role you ensure that Americans play internationally in the global economy. And I thank Chairwoman Waters for the nature of how this hearing went. We have disagreements. Those disagreements should be about policy. They should be about substance. And that is the type of hearing that you chaired today, and I think that is important and good for Congress, even amidst the sort of circus-like atmosphere in which we have to legislate and operate. So thank you, Chairwoman Waters, and I yield back.
I'd like to thank our ranking member, Mr. McHenry. for those comments, and I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you're able. So without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. With that, thank you, and this hearing is adjourned.